Hey everyone, welcome back to Corporate Decoder. Today, DWS Market Trust just filed its N-CSRS report for the D.W.S. Global Income Builder Fund, and I'm seeing some interesting details about their holdings that might surprise you. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a peek under the hood of what this big fund is actually invested in, and some of the percentages might make you do a double take. Alright, so what do we have here? This is a shareholder report, a sort of checkup on how the DWS Global Income Builder Fund is doing. It covers the period from November 2025 to April 2026. Think of it like a report card for the fund, telling you what it invested in, how much it costs to own a piece of it, and some key stats about how it is performing. It is important because it helps us understand where our money might be going if we invest in this fund. Right off the bat, they break down the costs. For class of shares, if you hypothetically invested $10,000, the cost for just 6 months would be about $45. That sounds small, but it is almost 1% of your investment when you annualize it. They say the gross expense ratio is around 0.90%, but without some waivers, it would have been higher. So, these costs are real and they eat into your returns over time. Then we get to the big picture numbers. The fund has over $619 million in net assets. That is a lot of money. They hold 352 different investments, meaning they're pretty diversified. The portfolio turnover rate is 72%. That means they bought and sold about 72% of their holdings in the last year, which can mean more trading costs and potentially more taxable events, depending on how it is structured. Now, let's talk about what this fund is actually invested in. It is a mix of different things. A big chunk, 55%, is in what they call fixed income exposure. This is basically bonds and similar investments that pay a set amount of interest. Within that, about 21% is in corporate bonds, which are loans to companies. Another 15% is in government and agency obligations like US Treasury bonds. Then there is stuff like asset-backed securities at 8% and mortgage-backed securities, which are basically pools of mortgages bundled together. But here is where it gets really interesting. They also have 59% in equity exposure. That means stocks. So this isn't just a bond fund, it also invests heavily in the stock market. Common stocks make up 37% of that equity chunk, and then there is a huge 20% in equity index futures. Futures are basically bets on the future direction of stock market indexes. It's a way to get exposure without buying every single stock. When we look at where these investments are located, the United States makes up a big 82%, but then there is a significant 32% in non-US investments. This gives you some international exposure, but it also means you're subject to currency fluctuations and political risks in other countries. Let's dive into some of the actual holdings. This is where it gets specific. Under common stocks, they list out some big names. In the communication services sector, we see Singapore Telecommunications and Walt Disney. Then for interactive media and services, Trias Alphabet, both Class A and Class C shares, and Baidu. So, they are invested in major tech companies. Let's look at Alphabet Inc. Class of shares. They hold over 14,000 shares, valued at over $5.6 million. This is a significant position. Moving down the list under semiconductors and semiconductor equipment, we see Nvidia Corp. They hold over 57,000 shares valued at nearly $11.4 million. That is a huge bet on Nvidia, a company that's been a major player in the tech world lately. Now let's switch gears to the debt side, the corporate bonds. They list a lot of these. For example, At&T Inc. has bonds with a 3.55% interest rate maturing in 2055. That is a long way off companies like Charter Communications operating LLC meta platforms. And Paramount Global also show up here with various bond issues. Notice Meta Platforms Inc. They have bonds maturing in 2036 with a 5.25% rate and others in 2056 at 6.3%. These are substantial investments in corporate debt. Then we have the asset-backed securities. This category is 8% of the fund. We see things like Ally Bank Auto Credit Linked Notes, CarMax Select Receivables Trust, and Hertz Vehicle Financing. These are essentially bundles of loans, in this case, car loans. An interesting part of this filing is how they handle securities lending. They hold collateral, which is like a deposit to ensure the borrowed securities are returned. A big chunk of this collateral is invested in something called D.W.S government, an agency securities portfolio. This is basically the fund lending out its own securities and then investing the cash it gets back into another fund managed by the same company, D.W.S. This is where you see a lot of companies get more money, but it can also raise questions about how independent the investments are. They get about 3.56% yield on this collateral. They also have 8.4% in cash equivalents, largely in the DWS Central Cash Management Government Fund. Again, this is the fund parking money in another DWS managed fund, likely for safety and a small return. This shows how interconnected these funds can be. Looking at the total investment portfolio, the cost was over $610 million, and the current value is over $644 million. That means so far, on paper, the fund's investments have gained about $34 million. That is a good sign. When we look at the statement of assets and liabilities, it gives us a clear picture of what the fund owns versus what it owes. The total assets are over $654 million, with investments making up the vast majority of that. On the liability side, they owe money for investments purchased, and there are accrued fees. The net assets, which is what the fund is truly worth for shareholders, is just under $620 million. Now let's look at the specific share classes and their net asset value, or NAV. For class of shares, the net asset value per S-share is $9.67. The maximum offering price, which includes any sales charge, is over $10. This difference is important because it shows the initial cost for new investors. The statement of operations tells us about the fund's income and expenses. For the 6 months ending the 30th of April 2026, the fund earned over $11 million in income from interest and dividends. However, expenses are also significant, totaling over $2.5 million. This includes management fees, administrative fees, and other operating costs. The net result is about $9.2 million in net investment income. But that is not the whole story. The fund also had substantial gains from its investments. They reported over $13 million in net realized gains from investments, plus another $12 million from futures contracts. That is a lot of trading activity. On top of that, there were also changes in unrealized appreciation, meaning the value of investments that haven't been sold yet, but have gone up in value. All of this adds up to a net increase in the fund's net assets of over $36 million from its operations for this 6-month period. That is a positive result. Looking at the financial highlights, which breaks down performance on a per-share basis, we can see trends over time. For class of shares, the total return for the 6 months ending the 30th of April 2026 was about 6.17%. Looking back further, we see years with much higher returns, like over 20%, and also negative returns, showing that this fund can be quite volatile. The ratio of expenses for the class of shares is around 0.89%. This is the cost of owning the fund, expressed as a percentage of the money invested. For Class C shares, that cost jumps to 1.74%, a big difference. They also report a portfolio turnover rate of 72%, which, as we mentioned, means a lot of buying and selling. Finally, let's touch on the Advisory Agreement Board considerations and fee evaluation. This section explains how the fund's board reviewed the contract with DWS Investment Management Americas, Inc. They considered performance, fees, and economies of scale. They noted that the fund's performance was in the second quartile compared to similar funds, meaning it wasn't the best but also wasn't the worst. They also looked at fees and found them to be competitive, especially with expense limitations in place. When we look at the notes to the financial statements, specifically on organization and significant accounting policies, we see details about how the fund operates. They explain the different share classes, Class A, C, R6, S, and institutional, and how their costs and features differ. This is important for investors to understand before choosing a share class. They also explain how they value their investments, using different levels based on whether the price is from an active market, observable inputs, or unobservable inputs. The report also details their use of derivative instruments like futures contracts. They use these for various reasons, including managing risk and seeking to enhance gains. They have numerous open futures contracts with large notional values like 2-year US Treasury notes and E-mini S and P500 index futures. These are powerful tools, but they also come with significant risks. Looking at the statement of assets and liabilities, we see a snapshot of what the fund owns and owes on a specific date, the 30th of April 2026. Their investments are valued at over $584 million, with a significant portion being investments in non-affiliated securities. What is interesting here is the securities loaned amount, nearly $24.5 million. This means they lend out some of their assets to borrowers, usually for a fee, which is a way to generate extra income. The net asset value per S-share for each class is clearly laid out. Class A shares are at $9.67, Class C at $9.68, and institutional shares at $9.65. You can see that the share price is very similar across classes, but the fee structure and other costs can be very different. Digging into the statement of operations again, the realized and unrealized gains and losses play a huge role in the fund's performance. For the 6 months ending the 30th of April 2026, the fund had realized gains of over $26 million from its investments in futures contracts. This is a key driver of returns for this fund. The total return calculation is crucial. For Class A shares, it was over 6% for the first half of 2026. Past years show much higher returns, but also significant drops. This tells us that while there is potential for growth, there is also risk involved. Finally, the signatures at the end of the report show who is officially making these statements. Hepson Uzcan, the Principal Executive Officer, and Diane Kennelly, the Principal Financial Officer, have signed off on this report on the 29th of June 2026. This means the information presented has been reviewed and approved by the fund's leadership. So, what is my take on all this? This report shows a fund that is actively managed, investing in a broad range of assets, including stocks, bonds, and derivatives, the significant use of futures, especially equity index futures, and the high portfolio turnover suggests a dynamic strategy aimed at generating returns. The fact that they lend out securities and invest collateral back into affiliated funds is a common practice, but worth noting for any investor. The key takeaway is that while the fund has delivered solid returns in some periods, it also carries risks due to its active strategies and international exposure. What I am actually looking for is how consistently these gains can be achieved, especially considering the costs involved across the different share classes. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.